The traditional way of rebalancing a portfolio is broken. Everybody loves to be in balance, but what does that mean in regards to your investment portfolio? Many advisors will provide some formula, such as 60% in stocks and 40% in bonds. And of those stocks, 25% should be in blue chip, 25% in mid cap, maybe 25% in utility, and 25% international, or some other similar allocation. So what does that look like? Well, think about this. Hey, Fred, looks like your blue chip stocks are doing really well, so let's sell some of those. And the international stocks are really struggling, so let's buy some more of those. Wait, what? That doesn't make sense, but that is traditional rebalancing of a portfolio. To understand why our strategy works so much better, it's important to understand our overall philosophy on portfolios. What is the end goal of your portfolio? Most people think the end goal is to reach some magic number of how much they need to accumulate. Perhaps you've seen them too. Every financial advisor or investment blog or newsletter seems to have some magic number for how much you need to have financial freedom. Every one of them is wrong. I'm not saying I'm smarter than all of them. I'm just saying that they're asking the wrong question. They all look at the size of your portfolio as the single most important factor. Most financial advisors get paid based on a percentage of your portfolio. So the size of your portfolio is the most important number to them. Keep in mind, I was a certified financial planner for many years. I voluntarily gave that up many years ago and am no longer licensed to advise stocks or securities. But I was trained on exactly how to make these calculations. Anyway, start with the size of your portfolio and try to estimate how big that portfolio needs to be in order for you to retire. They calculate the estimates based on what they think inflation will be over the next 20 years. These are just guesses. What your expense budget will look like in 20 years, these are also just guesses. And how much you should withdraw annually from your big pile of money for expenses. Again, these are just guesses. Here's why that approach is wrong. How do you pay your bills? Your mortgage or your rent? Monthly. Your car payment? Monthly. Your car insurance? Probably monthly. Your utilities? Monthly. Your subscription services like Netflix? Monthly. Notice a pattern here? Whether you are retiring at a normal age, retiring early, or just seeking the ability to not be tied to a traditional job, your expenses will continue to be incurred monthly. What is the best way to know that you have financial freedom? Simple. To have enough passive cash flow coming in every month to cover those monthly expenses. The magic number should not be some daunting pile of assets like 1.46 million, that's based on the recent Northwestern Mutual survey, or 3 million based on the Fortune magazine survey, or 10 to 14 times your gross income, or something like that. The amount you need for retirement is the amount of monthly passive cash flow that will comfortably cover your budget, increase with inflation, and last as long as you do. Once you have achieved that, whether the value of those assets is $300,000 or $3 million, then you have achieved financial freedom. With that in mind, our goal is for you to receive lots of passive cash flow from a variety of different sources. We utilize 6 different markets in order to provide that diversification. Not every investment in all 6 markets provides cash flow the same way. Therefore, we break the investments down into 3 categories. Short-term assets provide passive cash flow for some unknown period of time that is usually expected to be 10 years or less. Other assets provide passive cash flow for 20 to 40 years, and we call these long-term assets. Finally, some assets will provide passive cash flow for as long as you're alive. We call these infinite assets. And this is important because the assets that are infinite often have a lower rate of return. Assets that are short-term typically have very high rates of return. Therefore, if you put the same amount of money into each asset, the short-term assets will provide a much larger portion of your passive cash flow. So how do you rebalance that? Simple. You do not sell an asset that is producing high passive cash flow. That just makes no sense. You would use the cash flow from that portfolio to purchase more of the long-term or the infinite assets so that your passive cash flow is balanced. Let's look at a simple 4-asset portfolio based on normal estimates of returns. So let's say you have $100,000 in real estate paying $750 a month, and $100,000 of a secured note paying $1,250. And then you have $100,000 in one of the trading funds we use that pays $5,000 a month, and you have another $100,000 in rental arbitrage that's paying $8,000 a month. That may look balanced because they all have $100,000. However, look at the cash flow. There's $15,000 coming in per month, but more than half of that is coming from one asset type. To rebalance, I would suggest that you put the cash flow towards acquiring more of the real estate. Perhaps you save up for 6 to 9 months and acquire another rental. What would the new portfolio look like? The value of the real estate would now be $200,000, and that cash flow would be $1,500 a month. The $100,000 secured note would still pay $1,250. The $100,000 in the trading fund would still pay $5,000, and the $100,000 of rental arbitrage would still pay $8,000. So I would then put that monthly cash flow towards acquiring more notes. I would continue investing in those two assets until they're producing $5,000 a month, like the trading fund. So not only does that give you balanced monthly passive cash flow with your income coming from 4 different sources, but you're using the short-term assets, the trading fund and the rental arbitrage, to increase the passive cash flow from your long-term assets and your infinite assets. And that just builds your long-term stability. That is how you create a portfolio of assets that provides diverse passive cash flow now and for a long time into the future. What you have when that happens, when you have enough passive cash flow from diverse assets and the cash flow increases with inflation and you will not outlive the cash flow, then you have financial freedom. Before I finish the video, please take a second to like the video. If you haven't already, please subscribe so you get more fresh content on how to build passive cash flow. Finally, if you have any family or friends who would like to improve their financial position, please share this video with them. Thanks, and I appreciate that.